Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, to discuss economic data and how it's slowly improving, particularly in manufacturing and industrial. Phil, it's great to have you with us. And it's not quite back to pre-COVID levels, but there is some improvement there.
Yeah, I mean, the reality is the economic data keeps surprising to the upside. So a lot of the statistics that are looking at expectations just keep getting outperformed. But to your point, the levels are still pretty far below COVID-19 or pre-COVID-19 levels for a lot of the data points. In just the last couple of days, we've had manufacturing, we've had industrial production. This morning, we got retail sales, all positive, all getting better than last month. But the news isn't all as good as it had been. The V shape that we'd been seeing is starting to turn into a swoosh. And so the rate of recovery is slowing. And I think there's a lot of headwinds that are out there, and potentially it's going to be harder to get all of the levels back to this pre-COVID levels.
Yeah, and then of course the question is employment. You know, we saw a bit of a surge as the economy started to reopen again, but it seems as if it may have plateaued a bit.
Yeah, that's another one of those data series that started to look like a V, and it's slowing down and actually sort of stalling out a little bit right now. And when you look at the change in employment, you can see that, you know, if industrial and production and all of those sort of sides of the economy are going well, not surprisingly, the goods producing industries hiring is getting pretty close to back to COVID levels. But the service industries are still well below COVID levels. So there's around about 11 million fewer jobs now than in February, and a lot of them are in the service sector. And I think what's important is the service sector was what was driving the markets and the economy before we had COVID. So the services were growing, even though world trade was slowing down and industrial production was starting to slow down ahead of the COVID crisis. And so now the service industry may turn into a bit of a headwind. And I think, you know, one of the things that could happen if that's the case is consumer confidence, which has fallen significantly, no surprise really with coronavirus. It's also taking a lot longer to recover, and it's not looking like a V shape at all. So if the reason we have low consumer confidence is because a lot of those employees are in the service industry and they don't see their jobs coming back very fast, that's when we start to worry about a longer term problem that looks more like a classic recession rather than a pandemic induced V shape with a strong recovery.
And so that's a great point that you make, because in 2019, part of the story was for the move in the stock market was, of course, predicated on the strength of the consumer. And I think that's why there's a little bit of head scratching going on now, even with the market at the levels of where it's at, because there's that disconnect there with the economy and the consumer being present to continue to drive that along.
Yeah, and I read this morning that around about 15% of retail sales might disappear just because of the lack of the extension of stimulus. So that could cause a hit to the retail spending numbers too. And we might start to see, you know, more realistic sort of headwinds ahead of us.
All right, Phil, great stuff. Thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.